As we reach mid-August 2025, investor sentiment is high, providing an environment for gains in both equity and fixed income markets. As of August 13th, the S&P 500 equity index closed above 6460, an all-time high level, and up about 10% in 2025 year to date. U.S. long-term interest rates, as measured by the U.S. 10-year Treasury yield, traded at 4.25%, which was below the 4.57% yield at the end of 2024. Just 4 months ago in early April, pessimism was extreme. Equities were substantially lower, and nervous fixed income investors drove yields higher. But those markets reversed, and equities relatively quickly have made new highs. In this short period of time, while there has been good news, equity prices, in our view, have moved ahead of the data, driving market valuations to high levels. This is especially true for valuations that compare equity index prices to earnings estimates, and the S&P 500 trades at a substantial premium to earnings estimates relative to averages over the past 10 and 15 years. Even as the rally continues, uncertainty remains very high, and it's prudent to have discussions about the durability of gains over the next several months. The good news can continue in our view, especially if consumer spending remains resilient, capital investment to support data center and other necessary generative AI infrastructure moves forward, and if economic incentives from trade deals and the recently passed budget bill can offset potential headwinds from tariffs. But we also acknowledge that market sentiment can fade if data falls short of high expectations, and when equity market valuations are elevated, investors should scale back return expectations and market pullbacks are likely. Our message is to stick to the plan, though, and remain invested. And this becomes a great time for long-term investors to once again review portfolio exposures relative to their investment plans. Much like we encourage investors to do this in down markets, it's important to apply this same discipline in a strong market as well. Our familiar message is to rebalance portfolios, keeping sector and asset class exposures in line with predetermined ranges. I mentioned earlier that the S&P 500 index has gained 10% year to date through August 13th, and since March 31st this year, the index gain was more than 15%. Each of the 500 index constituents reside in one of 11 sectors, and there's been a wide range of sector returns since March 31st. The top sector performance since March was technology, up about 33.5%, but 3 sectors were actually lower since then: healthcare, energy, and real estate, with healthcare down about 8.8%. For many investors, their portfolio exposure to technology has surged, while healthcare exposure has declined. This doesn't mean that technology exposure should be eliminated, and in fact, as the largest weighted sector in the index, it will remain a core sector holding in many portfolios. But as it becomes overweight versus portfolio goals, exposure can be trimmed and allocated to these underweight sectors. This discipline is important across market environments and follows the mantra to buy low and sell high. Rebalancing portfolios keeps overall market participation intact, but broadens out exposure with the goal of managing risk. For specific recommendations and strategies, please contact your D.A. Davidson financial professional.